Let's shift gears now and we'll be speaking to Junaid Bray. He's a portfolio manager at Laurium Capital and he's going to be talking to us about all things in terms of South African equities. Junaid, I know you've got a lot to unpack, so over to you.
Hi, I'm Junaid Bray. I'm one of the portfolio managers at Laurium Capital. We manage the Nedgroup Investments SA Equity Fund and we partners with Nedgroup Investments on this fund. So just to give you an overview and background on the fund, we've been managing the fund. We've got a track record going back just about 11 years, over 11 years now. And the fund is fully invested in SA equities, JSE listed equities only. No cash really, just for trading purposes. So the fund is a good building block to use in portfolios for your SA equity component. So just looking at the track record of the fund's delivered about 22% year to date, also about 22% over the last year. And if you go back 9.4% since inception, which goes back about 11 years, and that's just ahead of the benchmark as well as the peer group. A stat that we like to look at that highlights some of the consistency of the performance of the fund. If you look at the bottom row on rolling 5-year periods, the fund tends to outperform the benchmark as well as the peer group about 2/3 of the time. And I think we will go through periods where we lag behind, but on average over the history of the fund, 2/3 of the time we've outperformed the peer group and the benchmark. Just looking at more or less where some of that performance has come from this year, and I'll touch a bit more on that, on what's driven the market. But in terms of what we've held in the fund, gold and precious metals. So Anglo Gold has done nicely for us, Impala Platinum, Northern Platinum, as well as having positions in Naspers and Prosus, as well as Anglo and Anheuser-Busch as well, and Anglo American. So looking at the market review and the outlook, in terms of what the markets look like in the last while. So looking at our SA equity fund, and we looking at the JSE Caps Wix, and comparing that to global markets, that's the MSCI World Markets, as well as the S&P 500 and the MSCI Emerging Markets, and obviously putting this all in dollars so they're comparable. The JSE has actually had a spectacular performance in the last while. So in dollar terms, year to date, to the end of August, the JSE is up, Caps Wix is up nearly 32%, while outperforming global markets. And then over 1 year, you can see the performance as well. And then over 5 years, we've actually compounded at 16% in dollars. And that's outperformed even the mighty S&P 500 at 15%. Now, look, we are capturing some of the COVID base. 5 years ago, we're still coming out of COVID and we took quite a drawdown there. But if you think about the Mag 7 and what's driven the S&P 500, NVIDIA, etc., we've actually outperformed the S&P compounded over 5 years in dollars. If we look more recently year to date and going back into Rand performance, the Caps Wix has done about 23% year to date. And now what's driven that? Look, it has been quite a narrow market. And if you look at gold and precious metals, so the bars on the right side, those will add up to the total performance. And we've just put the top performers that has contributed to the 23%. So gold's delivered nearly 10% of that 23 has come from gold. Naspers and Prosus about 5, and then PGM's about 3. Telcos have also been quite strong. That's delivered almost another 3, and then there's a tail after that. So you can see this year it's been quite a narrow market. And what that means for our local market. So we know we've had very strong gold prices, and we know multiple reasons for that: geopolitical issues, a weakening dollar, concerns about the independence of the Fed, etc. All of that driving the gold price higher, along with massive central bank buying. So we know that's been the case, and then we also know that the PGMs have been stronger. So if we think about what that means for South Africa, I think historically going back, we were a big gold producer, and even though gold's fallen, it's still significant. So I think as a percent of our exports, gold still represents about 7% last year of our exports, and then PGM's another 9%. So combined, about 16% of our exports, gold and PGMs. And what this chart really shows you is the terms of trade. What that means is effectively your exports less imports. And you can see that if you look at a proxy for that, if we just take gold and platinum, less oil, because about 20% of our imports are oil-related products. You can see that how that has spiked as oil has fallen and gold and PGMs have risen. Now that's got huge implications for our economy in a positive way, actually. If prices stay high for the gold and precious metals, it will obviously result in a better trade balance because your exports are rising and your imports are falling. And what I'm showing you on this chart is really, it's been actually put together by the Nedbank equity sales team. And they sent this out. So that if you're just taking at spot prices, given the weights of the different commodities in our export basket, there's a more than a 1% positive impact on GDP. And with oil falling, there's a 2% positive impact. So net, very positive. And if we put that all together, I think you've obviously got a positive impact on GDP. That's the one thing. Then as the companies, the mining companies produce better earnings, they're also paying more taxes and royalties to the government. So that reduces some fiscal pressure. We know that our budget this year, there was a bit of an impasse on the budget with about the VAT increase, all of those things. And going into next year, it does take a bit of pressure off if the prices stay high. Then what we've seen historically, when the prices are this high, there is a flow-through effect with a bit of a lag of about 9 to 12 months. But historically, there has been a correlation with consumer spending, actually, as it eventually the multiplier effect as it flows through the economy, that could come through. And then from a consumer spending perspective, it has been a bit lackluster given the higher base that we saw from last year. But inflation is falling, and interest rates, there's still scope for maybe some more cuts. So that could support the consumer on that side. Then we've also got the GNU backdrop. Now, it hasn't been without its issues. Obviously, you've got different parties in a coalition government with different ideologies. There were always going to be some issues there as they try to work together. But I think overall, as long as it remains intact, and we still put a higher probability on the GNU remaining intact, that reforms will come through in the medium to long term. Now, the reforms have been slower than we would have liked to have seen, going back about post-election last year. And we have seen GDP revisions downwards, unfortunately. But I think even listening to company management, I think some of the reforms over the medium to long term are still happening in the background. We know load shedding, we don't really talk about it much anymore. It's not an issue. That's largely been addressed. The next thing that's going to be addressed is logistics. I think that's quite a bottleneck at the ports, on the rail lines. And we've seen bids being opened up for private sector players to get involved on the rail side. Now, that won't come through in the short term. Again, it's a 3 to 5 year story. But again, the direction of travel over the next 3 to 5 years in the medium to long term looks positive. And when you put all of that together, I think if the dollar keeps weakening, because it looks like they might cut rates again in the US, and it might, with all the geopolitical issues ongoing, you might see the dollar continue to weaken, and that's generally positive for emerging markets and commodity prices. So South Africa stands to benefit if that happens. Now, when we look at that backdrop and we look at valuations, in the earlier slides, I showed you the drivers behind the strong performance on the JSE Capswix this year, and it hasn't really been domestic shares. So domestic shares have actually underperformed. And from a valuation perspective, if you look at the black line on the chart, this is an index that we put together. It strips out all the mining companies and the offshore earners, and it really represents South African-focused companies. So mostly your banks, your insurers, your retails, and your South African industrials. And it looks at the valuation of them. So you can see we're trading about 1 standard deviation cheap. Now, the interesting thing is the bond markets have actually rallied the other way. So the green line on this chart represents the bond yield, and it's inverted. So as the yield strengthens, it's going to move up on that chart. But you can see generally the PEs tend to track what the bond yield does, because as the risk-free rate, the cost of equity is priced off, it uses the 10-year bond yield generally. And you can see there's been a dislocation in the last year. So bonds have rallied, but our equities haven't followed. So that gives you a valuation underpin. Then when we look at how our market looks relative to emerging markets as well as global markets, we're still trading very cheaply. So I think there's a strong case to be had for SA equities. And then positioning wise, we really like banks and we've got a substantial amount of banks in the portfolio. About 20% of our portfolio is in banks. And I just wanted to highlight, what the valuations look like on the banks. So you can see for ABSA, for example, there's a lot of positivity around, the new CEO coming in. There's a bit of a turnaround opportunity there. And if you look at the valuations, they're trading one standard deviation cheap on several metrics, on the PE on the top, on the dividend yield at the bottom. You're earning a 9% dividend yield. First rand as well. Similarly, if you look at on all valuation metrics, one standard deviation cheap at least. I actually saw results yesterday. A very positive message from the CEO. I think, in terms of the lending appetite, the non-interest revenue coming through, and excellent cost control also. So I think well poised to benefit from a more positive macro backdrop. And those are two larger positions in the fund. So overall, how have we positioned the fund given that backdrop? If you look at a high-level snapshot of the fund, I mentioned about 20% of the fund in banks, and why we like banks. Naspers and Prosus. So I think we really like Tencent. I think that there's a lot of hype around AI, but I think Tencent is really one of the companies in China to benefit from AI. They've got a user base of 1.4 billion WeChat users, and they've really got a super app. So once you're in that ecosystem, you message, you use AI search, games, shopping, all through the app, and using AI for better game development, for better ad conversion within the app. There's strong tailwinds, as well as they benefit from cloud as well, as they invest in that side also. So I think all of that coming through within that ecosystem. There's strong structural tailwinds for Tencent. I think they're a real winner in that case. And then outside of Tencent, if you look at the ex-Tencent assets within Prosus, for the first time turned cash positive, so they're not burning cash anymore. And that food delivery portfolio and the classified portfolio looking a lot better. So we quite like that, and 16% of the portfolio in that. Gold, we've been trimming gold as it's run. That's still about 13% of the portfolio, and most of that's through Anglo Gold and some Goldfields. So Anglo Gold's been our preferred pick there. PGM's about 7% of the fund. I think, we've held onto our PGM position for the last couple of years. Our view and our thesis was always that the electric vehicle penetration story was not going to be as bullish as expectations were. We felt that practically to implement that, as once you remove subsidies, it wasn't going to be as easy as the targets were expected to be. And on that grounds, we felt we held onto our positions, and this year it's come back quite nicely. And we think hybrids is really the solution where you get the best of both. And of course, hybrids still use combustion engines, using platinum and precious metals in the auto cats. So that's still there. And then on the domestic side, 7% exposure to retailers and about 6% to industrials. So a high-level snapshot of the way we think about the fund in the different broad silos. So on the non-resource rand hedges side, the global consumer side, I've spoken about Naspers and Prosus. Anheuser-Busch, I think there's a strong cash delivery story there and de-gearing coming through. Globally diversified, largely EM, about 70% of the portfolio is emerging markets. Bidcorp, it's a food distribution and services business. Very stable, geographically diversified, the UK, Europe, Australia, and well-run and ungeared balance sheet. We've got that in the fund. And then British American Tobacco, after several years of underperformance, this year it's been very, very strong. We still hold in the fund. Then the part that we're quite excited about, actually, the SA Inc. side, made up of the financials as well as other SA Inc. I've spoken about the banks and why we like them. We've also got some insurers in the fund, Sanlam and Momentum, which has done well for us. Then on the other side, despite the tougher macro backdrop, I think our companies are accustomed to operating in a tougher macro environment. So we've gone for companies where there's self-help stories, where they can still improve margins, cut costs, improve margins, despite the softer macro backdrop. And we've held TFG in the fund. We've also added in the last year Remgro and Bidvest. And then on the resources side, I think copper is our preferred metal at the moment. We've had quite a bit of Anglo American in the fund. And it was nice to see that deal come through recently with the merger with Tech. I think what you end up with is a very high quality copper portfolio, which makes up over 70% of the new entity. So we're quite excited about that, and of course the special dividend from the Valterra sell down. Then exposure to gold mainly through Anglo Gold, and we've got still holding on to our PGM position through largely Implats, and we've added to Valterra recently in the Anglo sell down. So I think high level that gives you a snapshot of where we are and what we're excited about in the portfolio. Thank you.
Junaid, thanks so much for that presentation. It was really great to get a sense of the lay of the land in terms of South African equities, which has been interesting because relative to developed markets and in US dollar terms, SA equities has outperformed most of them. Yet we are seeing a lot of foreign investors that remain pretty absent from this market. Choosing to go into your local bonds as an example. What are the things do you think that are likely to be a catalyst to bring back foreign investors into the South African market?
Sure, thanks, Tamisha. Yeah, look, it's a good question. So I think we've, on the previous slides, I highlighted how narrow this rally's been. So you can see where that rally's come from. It's largely been precious metals driven, Naspers process, and then telcos. So I think we had a little bit of interest from foreigners post our election last year and the formation of the GNU. We saw some foreign interest in our market, and we could see valuations on some of the domestic names like the retailers had actually increased quite a bit. As GDP growth has actually unwound or been revised downwards, we've actually seen interest wane. And I think even at that point, a lot of investors had been waiting for more concrete, tangible evidence of a turnaround and reforms in South Africa before actually deploying capital. That being said, I mean, a lot of interest, in terms of anecdotally, listening to some of the sell side brokers, etc. There is a lot of interest and a lot of appetite to deploy if they do see any signs. In fact, next week we've got one of the largest domestic SA equity conferences. The RMB Big Five conference happens next week, and from what we hear, there's a lot of foreigners attending this year. Looking to deploy. So I think if we see more concrete signs of a tangible turnaround, perhaps an increase in business confidence, upward revisions to GDP, I think those are some of the signs that foreigners are waiting for to deploy into SA equities.
Yeah, and finally get that sticky capital, private fixed capital formation. Let's now, look at the banking sector, which obviously makes up a huge portion of your exposure. So we're looking at about 20% or so, and you're talking about, investor interest or how, I suppose, investors are deploying cash. So if you look at the various banks and their strategies and their, geographical, I suppose, diversification. So the likes of your ABSA and Standard Bank looking into the African continent, First Rand with the UK, Nedbank primarily in the South African space. How much of a factor is the, I suppose, exposure to different geographies when you look at doing a valuation on the various banking stocks?
It's a good question. So I think, look, they all have different strengths and weaknesses, and I think that you need to take into account, what is the bank good at in terms of the area that they've deployed capital into. So if I look at First Rand, for example, they've got exposure to the UK, but it's only 10% of the group. In fact, if you looked at that on a standalone basis, it would probably be a cheaper valuation than the rest of the group, despite being in the UK, and purely on a returns basis. So that division generates about a 10% ROE. The rest of the group is north of 20%. So just on valuation and developed market, the UK banks don't tend to trade at very high multiples anyway. So from a valuation perspective, it's actually slightly a bit of a drag on the rest of the group. If you look at Standard Bank on the other end, I think they've positioned themselves as a real pan-African bank and have done very well. In fact, 45% of earnings comes from outside of South Africa, in Africa. And I think they've built a fantastic franchise. As some of the multinationals have left Africa, I think it's left a gap where Standard Bank has largely filled that. And they're the go-to bank, I think, for a lot of corporates operating on the continent. And they've done that very profitably. So if you look at, so the returns on the Africa business is actually very high, and it does support the valuation. That being said, again, also we've got an Africa fund, and we do analyze banks in Africa. Standalone valuations in Africa are quite low because obviously the cost of equity is a lot higher. So standalone valuations are quite low for in-country banks, but when you got that all in one group like Standard Bank, it actually does support the valuation. So we do adjust for that. And then Nedbank, for example, has decided to exit EcoBank, and so they've focused largely on South Africa. So you're pricing largely off the South African risk-free rate, the 10-year. And for all of these banks, ultimately, largely you'd use the South African risk-free rate to start the valuation. And we've seen that dislocation. So we think there's a case for a re-rating in these banks.
I'd like to shift focus from the banking sector to the resources, because that's been an area that's definitely has grabbed a lot of investor attention. Looking, I suppose, at your gold stocks, your platinum miners, making up quite a more substantial part of the index. Do you think this concentration that we're seeing is justified? And I guess going forward, how are you approaching the change in dynamics? This is great news, I suppose, from an SA perspective, as you were saying, that this is good news for our terms of trade. But how are you navigating, these very, I guess, more loftier valuations that we may start to see?
So if you look at the underlying commodity prices, so gold sitting at $3,600, north of $3,600, and the PGMs having picked up as well, it's not completely unexpected that with that backdrop that the equities are going to run. Look, it's not without risk, because you've obviously got concentration risk, as you were alluding to there. I think gold is now 15% gold stocks, 15% of the index. PGMs are another 7%. So just precious metals, we got north of 20%, almost a quarter of the market just in those. So there is concentration risk with that. If the commodity prices stay where they are, the valuations are actually not that expensive, and for that reason, we still have a significant exposure in our funds, as I showed on an earlier slide. You're still generating decent free cash flow yields of 10% in the gold stocks, and we still think that there's a reasonable outlook for PGMs over the medium term, because we think there's structural deficits in most of the major metals looking out of the medium term. So I think from that perspective, I think we're still okay, but it does pose concentration risk, and we are dealing with commodity prices where it could pull back, and on that basis, we do manage the position. So from a bottom-up perspective, which is the way we start the portfolio. We've gone for the ones that they've got better balance sheets, they've got better quality assets, so that in the event of a down cycle, the gearing is less. You're not going to go deep into the cost curve, into a loss-making position. We've gone for the better quality stocks within that, but we are monitoring it. And from a valuation perspective, when it does get expensive, we will be reducing as we've done with some of the strength that we've seen come through.
Really appreciate your time, Junaid, and thank you so much for that insights. Of course, that was Junaid Bray. He is a portfolio manager at Laurium Capital.